If you've been on the internet at all lately, you've probably seen them, these really alarming headlines and viral videos warning that a new financial crisis, a so-called GFC 2.0, is literally right around the corner. So today, we're going to cut through all that noise, investigate the actual evidence, and figure out what is really going on.
Okay, let's just dive right in. This is the big question, right? It's the urgent fear at the heart of this whole panic. And it's all centered on this huge but kind of little understood corner of the financial world called private credit. Basically, it's where businesses get loans directly from big investment funds instead of traditional banks. And the fear is that a crack in this one market could bring the entire system crashing down.
I mean, listen to this. This is a chilling warning from a viral video that's been making the rounds. The claim is that the warning signs of a 2008-style meltdown aren't just coming, they're already here. And apparently, it was all triggered by a totally unexpected move from one of the world's biggest banks. So what's the actual smoke signal that has everyone so spooked? Well, it comes down to a market that absolutely exploded in the shadows after the last crisis, and is now, for the very first time, hitting a major wall.
Yeah, that is the staggering size of the private credit market. We're talking about almost $2 trillion. This is money that specialized funds lend directly to companies, completely bypassing the public stock and bond markets. For years, this was Wall Street's hidden gold rush, and now it's facing its first real stress test.
So to really get what's happening here, we need to meet the cast of characters. Think of this like a high-stakes drama with 3 key players. And as you're about to see, their fates are all deeply connected. First up, we've got the massive asset managers who run these private credit funds. Now, because they do bank-like things without being regulated like a normal bank, they often get this nickname, shadow banks. And let me tell you, right now, they are feeling the heat. And you can see the problem right here with giants like Blackstone and BlackRock. These huge funds are being slammed by a flood of their own investors, all demanding their money back at the exact same time. See, the problem is they promised everyone easy access to their cash, but that money is actually locked up in long-term loans. So now they just can't pay. Next up, we have the global mega banks. We're talking about the household names. Now, they don't just watch this from the sidelines. They are the engine room. They provide the borrowed money, the leverage, that supercharges these private funds. Think of it like pouring gasoline on a fire. It makes the good times better, but it also makes the bad times so much worse. And this is where we see the risks start to spill over. It's not just contained in those private funds. Just take a look. Deutsche Bank, sitting on $30 billion of exposure, has seen its stock get absolutely hammered. JPMorgan is already getting nervous and starting to cut back on credit. This shows the contagion. This idea of the problem spreading isn't just a theory. It's already happening. Okay, so the panic definitely feels real. But how much of it is actually justified? Let's put on our detective hats for a minute and try to sift fact from fear by looking at the most alarming claims being thrown around. So, you know that claim that JPMorgan is pulling the plug? Well, it turns out that's actually true. They're getting really worried that the collateral backing their loans, in this case loans to software companies, could suddenly become worthless because AI is disrupting that whole industry. That's what people are calling the AI scare trade. And this brings us to the most terrifying argument of all, the contagion doom loop. The theory is basically a domino effect. It starts when the economy weakens and businesses begin to default on these private loans. Then, the private credit funds can't pay back the megabanks that lent to them. From there, the fear is that the banks totally panic. Credit freezes up everywhere, and the whole system just grinds to a halt. And when you look at the market data, you can see this contagion is real, but it's also very targeted. You see that huge drop for Deutsche Bank and the hit to the megabanks in general, but then notice the smaller regional banks way over on the right. They're mostly okay. So that tells us the fire isn't spreading everywhere, at least not yet. So with all this evidence on the table, what's the verdict? Are we looking at a contained correction, kind of like a bonfire that's just going to burn itself out? Or is this the start of an inferno that's going to consume the entire financial system? Right now, experts are fiercely debating 2 totally different interpretations of the exact same facts. You've got the bears, who see the ghost of 2008 all over again, and then you've got the bulls, who see this as a painful but frankly necessary cleanup in just one corner of the market. And honestly, the entire bullish argument really boils down to this one chart. Just look at who actually owns this stuff. A massive 80% is held by institutional investors. Think pension funds. Their money is locked up for years. They literally can't panic sell. The part that's in trouble is that much smaller 20% slice owned by individual or retail investors, the ones who were promised they could cash out whenever they wanted. And this Right here is probably the single most important distinction. 2008 was a default crisis. It was fueled by truly worthless assets, bad home loans, that were all packaged up to look safe. Today's problem, at its very core, is a liquidity crisis. The loans themselves might be okay, but the problem is a structural flaw. These funds promised investors they could get their money back anytime, even though that money was tied up for the long haul.
All right, so let's zoom out here and land on the main takeaway from our whole investigation. What is the real story here? And more importantly, what does it mean for all of us? At the end of the day, this isn't a story of mass corporate defaults, at least not yet. It's a story of fund managers making a promise that they simply couldn't keep. They sold a product that is fundamentally illiquid. These are long-term business loans, but they promised investors they could get their money out easily, almost like it was a bank account. And when everyone rushed for the exit at once, that promise is shattered.
So, where does that leave us? Well, while those GFC 2.0 headlines are definitely scary, the evidence really points to a much more contained outcome. This looks like a really severe, painful correction for a specific group of investors and funds, not the catastrophic unraveling of the entire global banking system.
And that leaves us with one final and, I think, crucial thought. We may have avoided an exact repeat of 2008, but this whole crisis reveals totally new vulnerabilities in our modern financial system. You know, as more and more money moves into these private, opaque markets, it just makes you wonder, have we just traded one risk we understood for another one we're only just beginning to comprehend?